everyone, my name is Emily and welcome to today's trading tips. Let's get started. Thinking in probabilities. Facing reality is very important, so let's just say you have an average of 150 trades per month. Some of them will be winners and some of them will be losers. Don't try to beat that. There are people trying to have an accuracy of 100% hit, and that's just not going to happen. That's like saying you can predict the flip of a coin 100 times in a row. No chance. Also, the financial market moves with probabilities. In certain cases, the probabilities of the market moving in certain direction are higher. That's the moment you're looking to identify with and take advantage of. Psychology is key. Every trader is a psychologist at heart. When you're planning your next move, you must analyze market movements as well as master your own psychology. Never forget that fear on the one hand and the wish to advance yourself on the other are fighting within you. When you are setting your plan, it's not enough to analyze the market movements and the fundamentals behind it. You have to analyze yourself as well. If you are rushing into a trade, ask yourself, do I really feel comfortable with this trade? Or on the flip side, why am I not entering this trade? Such questions make your trading conscious. Master both greed and fear. Make them work for you, protect you from losses, and at the same time, let them enhance your own unique trading style. Thank you.
When the markets give you money, it's a good idea to take it, because you may not get the opportunity again. Some traders take the market for granted. Some believe they know where the market is heading. That could be possible for the long run, but for a day trader, you never know what's going to happen. So you have to take every opportunity you can. Some opportunities that come to you must be dealt with accordingly. When you come across a high conviction trade, you must step on it and you have to go all in. And this requires courage. These opportunities are rare and you have to take full advantage of them to be successful. A lot of traders tend to be interested in things that may not serve toward their overall goal. If you're trading, your main priority should be to protect your money. Even if things go completely wrong, you still have to continue. Traders are focusing more on how much they would like to make instead of keeping in mind how much they're actually risking. What if the unthinkable happens? Under normal circumstances, you should expect the market to move against you and test you. Are you prepared for the worst case scenario? My experience tells me that you should be ready for a bad day. And whilst it isn't a great thing to deal with at the time, being able to embrace it as a learning moment will make you a better trader. So a loss is particularly a win if you're able to learn something from it. I'm here to give you some ideas on how to accomplish a big goal. First, set your target and time it. Make sure you're realistic and calculated. State how much money you want to make and when you will acquire it. Be specific. Now turn your attention to a big target you have accomplished in the past. It could be a trading winning stake or a single trade winner. Identify the circumstances that contribute to achieving those. What were you trading? Was it moving higher or lower? What direction did you take? Think about what happened then in detail and break it down into sections. This will help you identify the circumstances that worked for you. Once you have all the information down, think of how you can use them again to your advantage. This will help you create a vision in your mind, which will then help you go out and perform. Use as much detail as you can. Envision your trading as vividly as possible. The more clearly you can see in your mind, the easier it will be to manifest. You still have to be realistic though.
I'm Cassandra. I'm from Singapore. Botswana. Wow, very interesting. We've got this is basically everyone from around the world. Okay. I'm glad you guys are here. It's so nice to meet you. I don't know if I will be taking you guys for these webinars every week, but most likely every alternate week. So, oh, from Philippines. Hey. Hey, love Philippines. I lived there for a few months. Was in the UK for a few months as well. Okay, that's the beauty of trading, right? You get to travel. More Filipinos. Okay, I'm just gonna start. Let's not waste too much time because I do want to kind of make sure everyone gets like what I'm going to share today. It is a very important topic. It's not a very hard topic today, but it is important because it's the basics. So I do believe so much in building your fundamentals, right? Like it's the same for the house, right? It's like the basic part is the most important because that's what is going to mold you into being a better trader. Okay, I'm just going to continue, but can you guys just let me know in the chat box how long you guys have been trading? I want to know like your experience, if I should be going slow, if I should be going fast, if this is too boring for you, because if you are a professional trader, this might be too boring for you. So do let me know how long you guys have been trading so I know. Oh, 5 years. I just want to let you know, Juha, that's longer than I have been trading. But yes, I have learned a lot. Okay, so hey everyone, welcome to our webinar today. We're going to cover Technical Analysis 101. We're just basically just covering technical analysis again. I have to start with the disclaimer, of course, because this is important. I want you guys to know whatever I share with you guys in this webinar should not be construed as trading advice. It should not be taken as a signal or forecasting of anything. This is purely educational, okay? So sometimes even when I am sharing setups and whatnot, only take my trades if you believe in my analysis, okay? Only take the trades if you believe in my analysis. If you don't believe in my analysis, do not take the trade. Trading, especially on margin, trading forex and CFDs is very, very risky, and it's not for all investors. So do be careful, especially if you're in trading on margin. If you trade on margin, the risk just multiplies by the margin you are using. Okay, so whatever I show you guys, it's purely, a lot of it is based on research from our part, and it's also a lot of it is my style of trading and how I became profitable as a trader. So it's not the only strategy or style of trading that is in the market, but it is what I have been using and has made me profitable. Okay, so for those who don't know me, you guys would not know me because it's my first time taking you guys. My name is Cassandra. You guys can call me Cass. Okay, I am an investment analyst and a prop trader here at Everest Fortune Group. We're a Singapore fintech company. Okay, so what we do is we specialize a lot in research, in trading. We spend a lot of time doing back testing, so we kind of know a lot of the characteristics about certain charts and certain pairs because we spend so much time looking at the chart. So whatever I shared you guys today is just research that we have done and we have found to be effective. Okay, so in terms regarding myself, okay, I am a profitable trader. I would say I'm a profitable trader. I've passed FTMO and my forex fund 4 times already. For those who don't know what these are, these are prop trading tests that requires you to be 10% in profit within the month. Okay, so I've passed that like 4 times already. I've consistently brought a 10% profit on a monthly basis, like month after month after month. I'm managing more than 300,000 in my personal account, actually way more than that, sorry. It's maybe closer to 1 million now, right? On my own personal account is US dollars. And basically why I'm here to share with you guys how I managed to be profitable, and hopefully you guys can imply that strategy into your own trading style, or if you already have your own trading style, because a lot of you here are beginners, but I do have someone here who has been trading for 5 years, right? So hopefully whatever I share with you, you can try to implement into your own trading style. If not, at least it's just good to see how other people are trading. So less than a year, 5 years, I just started. I'm a swing trader, 3 years, 3 months, fresh beginner. Okay, for those who are new here, I'm glad you're here because you guys have to get the basics right. Trust me, when I started trading, I just jumped straight in with real money. I didn't even bother with the demo account, okay? I went straight with real money and I got burned really bad. So for those who are new here, my advice to you, learning from my mistake, is to learn first before you jump into the ocean, okay? Learn to swim before you jump into the ocean, learn to trade, learn as much as you can before actually trading. Also, please do not put your life savings, please diversify, please use the correct risk management and whatnot. Okay, so let's start with the webinar proper. Again, do pay attention because this is the basics. You need to get your basics right so that you can stay in this game for long. I have to say trading is a marathon. It is not a sprint. It is not a get rich quick overnight game. Okay, it is a marathon. You're here to make a lot of profit over the years, okay, over years or over your whole lifetime. It's not like you're here to make money one day and then you just retire, whatever. Okay, it's a marathon, so do learn the proper skills. Okay, so I will, throughout the webinar, I will be asking you guys questions because one, I want to make sure you guys understand what I'm trying to say because it is very important. I think I do a lot of these webinars, okay, because we have collaboration with a lot of institutions where we do these webinars, and it's very important to me that my attendees end up being profitable in trading because that's the whole point of you guys being here, right? You're here to learn and end up being profitable in trading, right? And to grow your account. So it's important to me that you do understand so that you can eventually be profitable if you are already not profitable, okay? And not to scare you guys, I always tell this in all my webinars, not to scare anyone, but it is a reminder, rather it's a reminder to remind everyone that there's only, if you just Google how many % of retail traders out there are profitable, Google will say only 4% of retail traders are profitable. That means 96% are not profitable. Personally, I don't think it's 4%. I actually think it's 1%, right? It's not that easy being profitable in trading, but I am profitable. I know a lot of people who are profitable. So it's not easy, but it can be done. So what I'm trying to tell you guys, if you properly learn this skill, right? You properly learn this skill, you can be very profitable and it will change your life. I would say it will change your life. Okay, so let's start with our agenda for today. What can we expect from today's session? We can go through what is technical analysis, the different types of technical analysis, which one works best, and combining all of them together. So let's start. So what is technical analysis? Okay, technical analysis, I'm just going to give you guys the Google definition of it. Okay, technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. So behavioral economics and quantitative analysis use many of the same tools of technical analysis, which being an aspect of active management stands in contradiction to much of modern portfolio theory. Okay, so to say it in a different way, simpler terms, technical analysis is just basically tools and calculations that you use to narrow down where you think price is going. Okay, so by using technical analysis, you will be able to just kind of forecast or predict where you think price is going to go, and that's where the profit comes in, and that's where your account grows. Okay, just give me a sec. My Q&A box has disappeared, so I don't know if you guys are answering me or not, right? I don't know if you guys are answering me. Just give me a moment to see where the box is. Sorry, this is my first time using Zoom for this webinars. Okay, I think it's back. Can someone just say hi in the chat box so that I can still see it moving? Okay, thank you, Francis. I really appreciate it. Okay, let's move on. So what are the different types of technical analysis? Let's go through some of them right now. Thank you, RG. Thank you. So I'm not sure if I'm pronouncing your name. Thank you, Sabelo Senkosi. I'm sorry if I'm pronouncing your name incorrectly. Thank you, Juho. Okay, so what are different types? Let's look at some of them. So there's the first type is on-chart indicators. Okay, so on-chart indicators is when you look at the charts and you use the indicators that comes out on the chart. So example of it is the moving average, the Bollinger Band, the Downtrend channel, Ichimoku, parabolic SAR. So these are things when you click. Again, guys, whatever I'm going through right now is very textbook. Okay, it's very theoretical. It's very very textbook information. Later, when we move to the live charts, you will understand what I'm trying to say. If for those who are new here, especially for those who are new here, I'll show you exactly how to use the indicators as much as I can, because we do have a time constraint today. We only have 1 hour to, there's so much we're going through today. Okay, so these are some examples. There's so many more indicators, but these are some of the examples. Okay, today I'm just going to try to do an overview of everything. Okay, so we have off-chart indicators. So this is the chart. Off-chart indicators are things like stochastics, RSI, MACD, volume, ADX, ATR. They will appear at the bottom or the top of the charts, depending on how your chart layout is, right? But they're not on the chart itself, it's at the bottom. Okay, so these are some examples. On chart drawings, you've got support and resistance, trend line, channels, and chart patterns. So you can draw this on your chart where price is. Okay, you can see this channel. Okay, let me roughly go through what a channel is. So a channel is this thing. You will need 2 touches on the top and 2 at the bottom. Whenever we identify a channel, we're kind of narrowing down where we think price is going to move. So when we identify a channel, we kind of think that price is going to continue to move within the channel. So now that price is at the bottom of the channel, our next action, our next forecast or next idea would be that price is going to bounce from the bottom of the channel and go to the top of the channel. Okay, by the way, the bottom of the channel is called the support and the top is called the resistance. Again, everything will be much clearer when we move on to the live chart. Okay, other than that, we have your on-chart calculations. Okay, so some of the examples are Fibonacci retracement, extension, expansion, and projection. We've got the Elliott wave theory, and we've got the harmonics. Okay, so these are some of the examples of calculations that you can do on the charts to kind of forecast where you think price is going. Okay, so my question to you guys is, which one do you think works best? I think this is more to the people who have been trading for a while. The beginners for sure wouldn't know, because if you're new here, you wouldn't even, maybe you haven't even tried some of the indicators. So my question here is, which is the best? Okay, so we've got some answers coming in already. Thank you, Benji. Thank you, Brian. Thank you, Joash. Thank you, Muhammad. We've got some answers coming in already. Okay, so we've got someone saying MA, the moving average. Got someone saying the Ichimoku. I've got a Francis saying instincts. Okay, I've got Sarah saying channels, support, resistance. Okay, there's so many different answers. Okay, I want to tell you guys which one works best. The answer is none. On its own, none works best. Okay, I don't know if you guys have heard this saying, especially for those who have been trading for a while. Traders, okay, I've got someone saying RSI. Traders who trade based on indicators alone are traders who lose money in the long run. Okay, so the answer is that not yes and no. Yes and no. MACD is good, RSI is good, stochastics is good, price action is good, instinct is good, but no, they are not good on their own. The trick is, right? Oh, my slides are not moving. The trick is to combine them all together. Okay, when you combine them all together, it becomes very probable. Okay, I'll give you an example. I'm just thinking of one right now, so I don't know if it's the best. For example, you have a new partner, a new boyfriend or girlfriend, right? You bring them home. You have your mom, your dad, your sister, your brother, your grandma, your auntie, uncle, okay? So you have 7 people in your house. You bring a new boyfriend, your new girlfriend home. Your dad is telling you, I don't think this guy is good, right? Your mom is saying, oh, this guy is good. Your sister is saying, I don't think this guy is good. Your brother is saying, I don't think this guy is good. Your cousin, your uncle, your aunt is saying, oh, I think this guy is good. So you have 4 people saying that your new boyfriend or girlfriend is good, and you have 3 people saying that your boyfriend or girlfriend is not good, right? So based on probability, based on what the majority is saying, you would think that your boyfriend or girlfriend is good because you have 4 people saying that he or she is good and 3 saying that it's not good. So it's the same concept in trading, right? In trading, it's the same thing. When you have enough indicators, enough things telling you that, yes, this is a buy, you go in for a buy. If enough things telling that, yes, this is a sell, you go in for a sell, okay? Because our job as a trader is only to find probability. You have to remember this. This is so important. When I understood this, my entire trading changed. You only get in for a trade, for a buy or sell, if it's probable, okay? If you have a 65% chance of winning the trade, are you going to take it? If you have an 80% chance of winning the trade, are you going to take it? There's no such thing as 100% in trading, okay? Anything you do in life, there's no such thing as 100%. I'll give you an example. If you are crossing the road, even if you cross the road right now, there is a chance you might get hit by a car. There's a chance that, like, for some reason, a wild animal bangs you and you drop and you still get hit by a car. There's a chance you won't get to the other side safely. Okay, so everything in life has risk, the same as trading. So to decrease your risk of losing or increase your risk of winning, so to increase your risk of your chances of getting to the other side of the road safely, what you do, you look left and right. Okay, that increases your risk, right? To get to the other side safely. You can use a proper pedestrian that increases your risk of getting to the side safely. So that's the same as trading. The more indicators you use, okay, not the more indicators you use, the more effective indicators that you use, the more accurate your data is, the higher chance you have of winning the trade and the higher chance you have of growing your account and being profitable. Okay, I think this is a very, very, very important mindset to have. It's like you only want to get into trades that are probable, okay, that you have a high chance of winning. Okay, and how do you have a high chance of winning? You combine technical analysis, you can even combine fundamental analysis, you can combine as many things as you can that tell you the exact same thing. Yes, everything is telling me that this is a sell, I'm going in for a sell. Everything is telling me that this is a buy, I'm going in for a buy. Okay, so this is very important. Not trading, anything to do with life, everything is just probability. It's your chances of winning. Okay, more so in trading, because trading is a very factual game. It is very, very factual. There is nothing in trading that is based on feelings. Okay, nothing in trading is based on feelings. There's nothing, oh, I feel like price is going to go up from here, I feel like price is going to go down from here. Everything we do in trading is factual. It is calculated, and yeah, it's factual and calculated. So you already know your chances of winning before you even get into the trade. Okay, So here's an example of combining different things together. We're combining, in this example, we're combining the Ichimoku, the descending trend line, and the 23.6%. So you can see when we use Ichimoku, Ichimoku is showing that price is on a downtrend. Okay, there is a resistance here in Ichimoku. We can see that that resistance lines up exactly at the 23.6% Fibonacci retracement, and we can see that price is moving in a downtrend. Okay, so the Ichimoku, the 23.6, and the downtrend trend line is all lying in the same place. So we expect price to drop from here. True enough, it does drop from there. Okay, that's how amazing technical analysis is. Technical analysis can pinpoint where we think price is going to reverse, where we think price is going to break out, where we think price is going to do certain things. Okay, that's the magic of technical analysis. Okay, everyone good so far? Do you guys have questions? Can you guys let me know if you are still following me? Do I need to repeat anything? Because I'm gonna move on to the live charts already. Thank you, Francis. Thank you, Brian. Thank you, George. Okay, all right, everyone is good, right? I will be testing you guys throughout because I want to make sure you guys know. Thank you, Musa. Okay, so this is an example of a complete analysis. This is what a complete analysis would look like. Let's go to a forex pair. Okay, let's go to, do you guys have any requests? Anything you want me to look at? It can be forex, it can be index, it can be cryptocurrency, anything you want me to do an analysis on. Do drop your request right now. If not, I'm going to randomly choose one. I'm going to choose gold. Okay, BTC is fine. Okay, BTC is fine. Okay, we've got gold. Actually, let's start with gold first. If I'm not mistaken, I did see a buy opportunity for gold. Okay, but I will want to show you guys how I got that buy opportunity, right? Just want to let you guys know the buy opportunity may be right now. Okay, okay, so let's combine everything. Usually what I do, I'm just showing you guys. Okay, usually when I go to charts, the first thing I do, I clear the charts. Okay, I clear everything, remove drawings and indicators. I remove everything because we want to start with a fresh chart so that we are not swayed to whether it's buy or sell. We want to have no bias. We want to have no prejudice. We want to, you know, okay. We want no biasness. We want technical analysis to tell us if it's a buy or sell. Okay. So I don't want to hear my friends say, oh, you can sell crypto now, you can sell Bitcoin, blah, 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 blah. No, I want technical analysis to tell me that, okay, I want to collect the data and the information and I want to do it myself, okay? Because again, everything in trading is factual. Nothing is emotional. Nothing is based on hearsay. Everything is factual and calculated, okay? So usually how I look for my chart, when I look at my chart, I start with, can you guys let me know if you guys are swing traders, day traders, or scalpers in the chat? Okay, so swing traders, usually you look at anything from daily to weekly. You can sometimes look at the 4 hours as well. Okay, day traders, you look at the 1 hour or the 4 hours. Okay, and for scalper, you look at anything below the 1 hour. Okay, so personally, I am a day trader. So for today's analysis, I'm going to look at the 1 hour and the 4 hours. Sorry, I'm going to look at the daily and the 4 hours. Okay, I'm more to like day to swing. Okay, so usually I go to daily to reference what I see, and then I go to the 4 hours to look for my setup. Okay, let me show you guys what I usually do. When I go to the daily, the bigger time frame, first thing I want to do, number one thing I want to do, look for trend. Okay, I need to answer my first question. My first question is, what is the trend? Is it an uptrend or a downtrend? If I answer the first question correctly, from here, my chances of getting into a profitable trade has already increased by a lot. Okay, I feel like answering this first question would win you a lot. Imagine you keep getting in for a sell, but actually it's on an uptrend. And imagine price is going on an uptrend, but you keep looking for a sell entry. I mean, it's possible, right? But it's easier to play with the wave, okay? Me personally, as a trader, I am a reversal trader. That means price is going in an uptrend. I look for the reversal and I get in for the downtrend. Okay. But another way, what I recommend beginners to do, especially, is actually to trade the continuation. Okay. So price is going in uptrend. It's moving up. Every time it pulls down, it comes down, you get in here for the buy. Okay, it goes up. Every time it pulls down, you get in here for the buy. Okay, this is a continuation trader, and I recommend beginners to do this because it's easier to spot continuation trades. Okay, reversal makes you a lot of money, not all the time. Okay, it's hard to spot. Okay, ABCD pattern. Okay, we've got a Elliott wave trader here. Okay, so can you guys let me know in the chat box if you think this goal is moving on an uptrend or a downtrend on the daily charts? Can you guys just let me know? Because I need to see if you guys can spot what I am seeing. Okay, we've got someone saying down, we've got down, we've got up, up, down, down. Okay, up, we might all be correct, right? Okay, if you're looking at this part, yes, it looks like it's moving on a downtrend, right? If we're looking at the bigger picture, it's actually moving on an uptrend. Okay, why? Because there is an ascending trend line here. Okay, so what do you call this? This is a possible long-term uptrend, okay, short-term downtrend. Okay, so you need to identify the trend first. You need to identify trend first. Okay, I drew this ascending trend line. A valid trend line would need to have 3 touches. 1, 2, 3. At least 3 touches. 4. Okay, anything less than 3 is not a valid trend line, and you shouldn't be using that information too much. The whole point of trading is to collect information, collect as many information, and then decide where you think it's going, if it's going up or down based on the information you're collected. But when you collect information, you want to try to collect as accurate as possible information. Imagine you're collecting information, but actually the information is not even accurate, right? Chances of you losing the trade is going to be high. Okay, so a lot of you say downtrend, some of you say uptrend. The downtrend, possible downtrend, okay, possible channel, parallel channel. Let me see if this channel is working. Okay, yes, there is a downtrend. Nice. Okay, so when we spot the channel again, our forecast is that price is going to continue moving in this channel. Okay, but if price continues to move in the channel, just remember there's an ascending trend line here. Price might have a hard time breaking this, and it might have to reverse from here. Okay, it might have a hard time. Okay, so that doesn't concern us because that's quite far away, right? We want to see where price is going at this current point of time. Okay, let's go to the 4 hours. Let me adjust the channel because it is out of the box. Okay, I've got my channel. It's moving very nicely within the channel. Okay, let me only highlight this area. Okay, I'm just gonna only look at this area because we're gonna focus on the downtrend. We want to play the continuation. So when it went down, oh, we missed it. When it pulled back, we could have gotten in here for the sell and then continue. How do we spot this sell entry? We use technical analysis to identify this sell entry. Okay, how do we know when price came up that it was going to reverse here? Technical analysis will tell you that it was going to reverse there. Okay, so right now we're going to use technical analysis to see where we think price is going. Okay, okay, after I spot my trend, now I look for support and resistance. Okay, support and resistance is looking for horizontal support resistance. This is where current price is, right? Support and resistance should be nearest to where price is. We've got a resistance right here. This is called a pullback resistance. Okay, and we've got a support right here where price is right now. Okay, so when you draw things on the chart, you're using these things that you're doing to narrow down where you think price is going. Okay, you're going to narrow down. So based on my channel, I think price is going to continue moving to my channel. But right now I have a support resistance. Based on this support and resistance, I think price is going to move within this support and resistance. Okay, but that's why I say we need to combine as many things as possible to see if my analysis is even accurate. If I'm looking at this channel of, if I'm just looking at the support and resistance alone, just looking at it, I'm not even going to combine other things. I'm going to immediately think price is going to bounce from here. I'm going to enter here for a buy and my take profit is here, right? But I need other things. I need other things to confirm that my analysis is correct. Okay. Okay, let me see. So we've got our support and resistance. Next thing we want to do is find the strength of the support and resistance. For those who have been trading for a while, you know what I'm talking about. For those who are new here, I need to show you this example. I've been using the example. A lot of people say it's clear, so hopefully you understand what I'm trying to say. So this is the floor. Okay, you've got a ball here, right? You've got a ball here. You are the human pushing that ball. Okay, you're pushing this ball. You push it, you push it, you push it. Now there's a door. Okay, there's a door. The question is, are you able to pass through the door and continue pushing it? Or is the door very strong, or there's so much barrier in the door that you might have to reverse and do a U-turn? You need to turn back. Okay, the same analogy that we'll be using with the charts. Will the price have a hard time breaking this? If it has a hard time breaking, it means it's going to reverse from here. You enter for a buy. If it breaks this, it's going to break and go down lower, means you enter here for a sell. So now we need to identify how strong. Let me change this to first support and first resistance. Okay, we need to identify how strong this support is. By the way, those who are new here, support is under price, resistance is above price. Okay, it's just a way to identify where your horizontal lines are. Okay, so question is price going to break or is it going to reverse? Okay, now you're going to combine other things with your support resistance to identify how strong the support and resistance is. I'll give you an example. Maybe this is just a door. Maybe it's just a very light wooden door. But if behind that door, there was a 20-kilo rock, right? There was a 20-kilo dumbbell behind the door. Do you think you will have an easy time pushing the door and continuing? You wouldn't, because there is a barrier right now. There is a resistance right now stopping you from going to the next room. So then you will have to return back, right? Because you keep pushing the door, and you can't push it. So what do? I give up. I'm just going to turn back. Okay. So right now we want to identify how strong this door is, or the support is. Is there a rock here? Is there anything behind the door? Do I get in here for a buy or do I get in here sell? How do you do that? You combine it with Fibonacci. Okay, you combine it with Fibonacci. Later, you combine it with indicators. Okay, so Fibonacci, to combine Fibonacci, you first need to identify the pattern that is even available on the charts. You need to see what pattern is available on the charts to even use Fibonacci. So there's few patterns that we want to combine, want to look for. One is the Fibonacci retracement. Okay. One is the Fibonacci projection and expansion, and one is Fibonacci extension. I cannot go into details today because this will be teaching Fibonacci as a series on its own. We will have webinars teaching Fibonacci alone because Fibonacci is a super, super strong, powerful tool. Okay, I cannot teach you guys, but for those who are a bit more experienced, you will know what I'm talking about. For the beginners, you will just need to attend our Fibonacci webinar. Okay, so I see a Fibonacci retracement here. I'm now going to use the Fibonacci tool, Fib retracement tool, to plot the Fibonacci from the swing low to the swing high to project where I think price is going to go. Okay, so right now, when I use Fibonacci retracement, there is 5 levels I use. Fibonacci retracements are levels between 0 to 100. Okay, we have 5 levels that we look for: 23.6, 38.2, 50%, and 61.8%, and 78.6%. These are the 5 levels. Okay, right now we're using Fibonacci retracement to test the strength of the first support. So I just need to ask you guys a question. I want to see if you guys are still following me. Which Fibonacci retracement level is lined up closest to the first support? Can you guys just let me know in the chat box so I know you are still following me? Okay, thank you, Francis. Thank you, George. Thank you, Joshua. Thank you, Joha. Thank you, Derek. Thank you, Adam. Thank you, James. Thank you. I really don't know how to pronounce your name. S-V-E-N. Ven? Is the S silent? Kelsey is lost. Don't worry, Kelsey. We've got because we just started with IronFX, we're gonna start with very simple and then we'll gradually go on. Don't worry, don't worry. Okay. Okay, everyone got it right. It is the 50%. So right now, can you see the 50% lines up on exactly on the first support? Sometimes it doesn't line up on the first support. Sometimes it's below, on top, but as long as it's near the first support, I will accept it. Okay, so we're going back to the settings. We're going to get rid of everything that is not the 50% because we want our analysis to be clear and tidy as possible. Okay, we don't want to confuse ourselves. Have you seen those traders with those very messy charts? I don't know how they trade, man. It is so messy. I don't know how they even see the information on the charts. Very messy. I don't like it. I personally don't like it. I prefer keeping my charts clean. Okay, we're going to leave the 50%. Okay, so this is the first pattern we've identified using Fibonacci retracement. Second pattern, we've got the Fibonacci extension. Fibonacci extension looks like a Nike tick. Okay, Nike tick, you know the shoe brand Nike, right? It looks like this. It looks like a Nike tick. So it kind of looks like a V, but this end is longer than the first end. Okay, this is a Fibonacci extension. It can be the other way around also. Okay, it can be this way or it can be this way. So in this case, it's like this. Okay, right? This is called Fibonacci extension. Yes, for those who are new, it's gonna take a while for you to be able to identify these patterns on the charts. I know I saw someone talking about ABCD pattern, right? Alejandro, right? Alejandro, let me tell you, Elliott wave is one of the hardest pattern to catch, right? You need to first identify the very simple things like Fibonacci retracement extension before you can even identify things like Elliott wave. Elliott wave, some people can look at the charts and they wouldn't be able to see it. Okay, right now some people look at the charts and they wouldn't even saw the Fibonacci retracement. They wouldn't even saw the Fibonacci extension. Okay, so Fibonacci retracement, the one that we went through, looks like a V, but this end is shorter than this end. Okay, the second part of the V is shorter than the first part. So it's the other way around for Fibonacci extension. The back end is longer than the front end. So there's a Fibonacci extension here. How we're going to do this, we're going to plot the Fibonacci extension to see if anything lines up at our first support. Fibonacci extension levels are levels above 100%. So it's the 127.2, 1.382, right? It's not here sometimes, but these are the levels we'll look at. Don't worry, you can type in the levels yourself, and a 161.1. Okay. When you look at this, these are the 3 levels we look at for Fibonacci extension. None of the levels are near the first support. Okay, there is quite a distance from these 3 levels from the first support. So I'm going to not use Fibonacci extension because it's not going to give me accurate information. Okay, so I don't want to use a tool that is not giving me accurate information. I'm going to get rid of it. That's totally fine. We can don't use it. Okay, you don't have to force it. Next pattern I see is a Fibonacci expansion or projection. Okay, so it's a zigzag pattern. And most of you are from Europe. I hope you watched Harry Potter before. He has a zigzag on his head. That's the same pattern you want to identify on the charts. Okay, so for the Fibonacci expansion, you're going to take this part and this part, the first two parts, it is the two negative levels. Again, for those who are lost, don't worry, we have an entire webinar on Fibonacci. Okay, so it's a negative 27.2 and a negative 61.8. Okay, oops, sorry, 61.8. Okay, let me see if anything lines up. Okay, as you can see, both the levels are not lining up very nicely with the first support. We're going to get rid of it. We want it to line up nicely or close. Okay, why we want it to line up near to this? Again, back to this analogy, you're pushing the ball, you're pushing the ball, you're pushing the ball. If right behind the ball, there is a 10-kilo rock, you're going to have a hard time pushing the door, right? But if the 10-kilo rock is right here, really far away, you can push the door and then you can come here, jump over the 10-kilo rock and continue with your journey, right? Right? So if the 10-kilo rock is here, you're going to have a hard time pushing the door. Chances are you have to reverse from here, right? You have to turn back from here. If the 10-kilo rock is here, it's not even going to be a problem. You can push the door, continue with your life, push the ball, carry the ball, jump over the ball, the rock or whatever, okay? That's why you want the Fibonacci levels lining up as close as possible to the first support. That means your first support is in fact a strong support. Okay, I'm actually going to call a buy from this first support. I am telling you this because right now, can you see the candle is turning green? There is a chance that the buy might happen already. There is a chance the candle that has started already. Please do not jump into this trade. Only get into the trade after we're done with the analysis if you agree with my analysis. Okay, next thing you want to identify, Fibonacci projection. It's also the zigzag pattern, but this time you're taking 3 points. Fibonacci projection, you're using 61.8, 78.6, and the 100 level. Okay, nothing is lighting up. Nothing is lighting up here. Totally fine. We don't have to use this. Actually, when I was doing the analysis earlier, I saw two levels lining up here. Sorry, guys. When I was identifying this, right? There's a Nike tick here. Actually, the 161.8 lines up quite near to the first support. So we're going to use it. Okay. After we have identified a Fibonacci level, we're just going to highlight that level because support and resistance is never one number, it is one zone. It is a zone. It's a very tight zone. Okay, if it's too wide, then it's not a good zone. If it's a tight zone, it's a strong zone. So we've got a support here that is backed up by Fibonacci. Okay, so I would say right now you've got the door. Okay, the door is your first support. The door may be made out of wood. It's a very light wood, so it's easy to push the door, right? Right now we have the 50% Fibonacci retracement, so you've got one rock behind the door. Now we also have 161.8 Fibonacci extension. You got two rocks behind the door. So now my question is, do you think price will have a hard time breaking this, or do you think it's going to have a easy time breaking it? Do you think price will be able to break here and continue down, or do you think it has to reverse? Right? Can you guys let me know in the chat box? What do you think? Do you think price is going to reverse from here, or do you think price is going to have a hard time? Right. So I've got answer. Thank you, Orgy. Thank you, Brian. Thank you, Spencer. You guys think it's going to reverse because there's resistance here, right? Because there's barrier here. That's why it's going to, you think it's going to reverse. I personally think it's going to reverse too. But you know what? Think about trading and analysis. There's no 100% true, okay? Just because this is a door and just because there's two rocks behind here, it doesn't mean it is impossible to go to the other room, okay? It just means it's hard. It's hard too because there is two rocks, but it can be that you have very strong muscles, right? Maybe you have very strong muscles. Maybe when you get here, you are so strong, you can still push the door. So it's the same with trading. If the bearish momentum is so strong, right? There's so much bearish pressure, there is a chance price might continue, okay? But just on a normal, we are just expecting this human to be a normal human, okay? So we expect price to just be a normal strength price, okay? Right, thank you, Francis. That's what I'm going to move on now. So right now, based on the information I have collected, I have a bias that price is going to go up from here, right? Based on support and resistance, based on, oh, one more thing I actually didn't highlight to you guys, right? That there was actually a descending trend line here. Sorry, I didn't highlight this to you guys early on. Okay, there's a descending trend line here. There's a descending trend line here, which actually means that there is bearish pressure. Okay, it doesn't mean you have to look for a sell entry. It just means to take note that there is bearish pressure. Okay, it can be that you enter here for a buy, you buy it to here, and then from here you sell. Okay, it can mean that as well. Okay, so good question, Francis. What about indicators? Now we combine indicators. Right now, my analysis and my bias is that price is going to go here. Let's see what the indicators are saying. Okay, so a lot of times, if price is telling me one thing, my analysis is telling me one thing, I need confirmation. The indicators will be my confirmation. If the indicators are telling me, yes, this is a buy, I'm going to believe it. Okay, again, your job as a trader is just to look for probability. It is to look for probability. Just give me a sec. Let me see. Okay, it's look for probability. So based on my analysis, I think I have a 70% chance of winning right now. Okay, why? Why? I think 70% is quite high. Why? Because there's two rocks behind my door, right? There's two Fibonacci levels lining up as my first support. So I think this is 70% chance. If there was 4 levels lining up here, I would think it is 80% or 90%. But because there's only 2 levels lining up here, I think 70%. 70% is a quite high chance of winning, you know. It's you have a high chance of winning this trade. Okay, so now we're going to back it up with indicators to make our trade even more probable. Okay, so the indicators I'm going to use is stochastics, RSI, Ichimoku, and I usually use MACD. Okay, I usually use MACD, so I usually use this 4. Okay, I use this 4 to back me up. Indicators shouldn't even be called indicators. They should just be called confirmations, because I usually just use it for confirmation to back up and support my analysis. Okay. Okay, so what is Ichimoku saying? Why am I only using this 4? Okay, if you go into technical analysis indicators, there is hundreds and hundreds of indicators out there. Okay, there is no way you can use all 100. So what you're going to use is the ones that you have found to be effective. Okay, that's why back testing is so important. When you back test, you know exactly which indicators work well. So from back testing, I know that Ichimoku, stochastics, RSI, and MACD have been giving me very accurate information. I have to say me, I have to emphasize me, because some traders use different indicators. Some traders use Bollinger Band, some traders use Downtrend channel, some traders use envelope, and they are still profitable. Okay, but I personally have been using these 4 indicators and it has been helping me be profitable. Okay, so I will continue to use these 4 indicators. So what are these 4 indicators saying? Ichimoku, how you use Ichimoku is you look at the cloud. Okay, the cloud will give you a lot of information. The cloud is actually a form of support and resistance. So as we can see, the bottom of the cloud is lining up exactly where our first support is. Okay, so if I'm using the Ichimoku cloud, it is supporting my argument that price is going to bounce from here, because it is exactly where the Ichimoku cloud is. Sometimes, if we go back in past, we can see sometimes price comes to this cloud and it reverses. Okay, it comes to this cloud and it reverses. It doesn't have enough strength to break through the cloud, because the cloud itself is like the rock. Okay, it is a form of barrier. Okay, so right now the cloud is lining up with our first support, which is good. Okay, meaning that now that door has even more barriers. Okay, there's another rock here. Okay, let's see what stochastics is saying. Stochastics is saying 21, 21, 5, and 3 is the settings that I usually use for stochastics. Other than stochastics, all the other indicators, I just use the normal settings, the default settings. Okay, so stochastics is saying that price is at a support right now. Okay, so every time price comes to the support, it bounces. It comes to the support, it bounces. Comes to the support, it bounces. So right now it's at a support as well, same as the indicator. So stochastics is also agreeing with our analysis. That means now behind this door, there's a lot of rocks, man. There's a lot of rocks. Will this guy be strong enough to push through the rocks? Chances are he might be able to, but it's going to be hard, right? Price might be able to go down, but it's going to be hard. If price still goes down, then yep, it's totally fine. It just means that this guy is super strong, right? But chances are it's just going to reverse, okay? Let's see what RSI is saying. So usually how I use RSI is I look for trend on the RSI. Let me see. Okay, RSI isn't saying much. RSI isn't saying much. RSI is saying that the resistance is quite off. Price is not at a resistance yet, and there is chance that price might still move up a bit. Okay, I don't think RSI is giving us very accurate information, right? So if it's not giving you accurate information, don't use it, because again, your job as a trader or analyst to find setup is to find as accurate as possible information. You want accurate information, and then with your information and data, you decide where it's going, if it's going up or down. Okay, RSI wasn't giving very accurate information. We're not going to use it. Okay, so MACD isn't giving much information either. Usually with MACD, I try to see volume. MACD is saying that it's on a downtrend. It is on a downtrend, right? But MACD wouldn't be able to tell you if price is going to reverse or not. Okay, so MACD is not saying that information as well, so we're not going to use MACD. Okay, so how confident am I on this trade? I am now 75% confident that price is going to reverse from here instead of breaking through, because there's 1, 2, 3, 4 rocks behind the door. I don't think this guy is strong enough to push this door open, right? So I think when he gets here, he's going to try to push it, and then he's going to reverse. Okay, it's exactly what price is doing. It's trying to push, but can you see this wick? It is rejecting. Okay, it's rejecting. It's going to give up. Hopefully it gives up and it reverses, and we can get in for that trade. Okay, so we've got our setup for today. This is exactly how we use technical analysis to identify where we think price is going. I do think there's a high chance, like 75% chance, that price is going to go here. Okay, why only 75? Because the other way to use Ichimoku is also to look at this. Do you see this? Let me zoom in so you guys can see, those at home. Do you see this blue line and this red line? If the blue line is above the red line, it means that price is going up. If the blue line is below the red line, it means that it's bearish and price is going down. Right now, the blue line is below the red line. It's not giving me confidence that price is going to go up. Okay, but the other things are giving me confidence. So I would say 75% chance this is going to go up. I think this is an okay trade to take. I personally would take it as well. Okay, that's all I have for you guys today. This is exactly how I would use technical analysis to pinpoint where I think reversals and trades are going to happen. So now that we've got our entry, this is our possible entry, right? This is our take profit. Okay, and our stop loss, I'm going to put it somewhere around, I'm going to put it here, 50%. I'm going to pull out the 50%. And I pull out 61.8. Okay, why 61.8? So the whole point of Fibonacci retracement is to project where we think price is going. Okay, so I'm gonna pull this out. I'm gonna show you guys how Fibonacci retracement works. Okay, so we are expecting price to reverse at least one of these levels, at least one of these 5 levels. Okay, it's either gonna reverse at 23%. 38.6%, the 38.2%, the 50%, 61.8%, or 78%. Okay, in this example, it's going to reach the 50%. If it breaks the 50%, right? If it breaks the 50%, the next level is the 61.8%. So if it doesn't reverse here, that means it might reverse here. It's the same as this example. Okay, this is where the 50% is. Okay, if this guy manages to push through this door with all these rocks, there's going to be another door here. Okay, this door is where the 61.8% is. If he manages to push through this rock, this 61.8%, there's going to be another door. It's going to be the 78.6%. So along the chart, there's always going to be support and resistance. There's always going to be support and resistance. The question is price strong enough to push through? Okay, so I'm going to put the stop loss here because, right, I'm going to put my stop loss behind one of the doors because if he managed to push through this door, maybe when he comes to this door, he might not be able to push through this door and he might have to make a reversal. So if he makes a reversal from here, that means he doesn't touch my stop loss, which is behind the door. Okay, so similarly, I'm going to put my stop loss here under the 61.8% because if it comes down and breaks, it might reverse from 61.8% and miss my stop loss. Okay, it might just miss my stop loss. Okay, and you might be able to still save this trade. Okay, might be able to save this trade. It might come here and then do this. You can get out at entry, or it might actually go back to your initial take profit. Okay, so that's all I have for you guys today. That's exactly how we'll combine. I do not recommend anyone taking this trade unless you agree with my analysis. Okay, the risk is entirely up to you. Please do not sell your kids. Do not put your life savings. Do not go all in on this trade. Okay, 75%. I'm not 100% sure. I'm only 75% confident of this trade. Okay. Yes. I've got 2 more minutes. Can you guys let me know if you have any question, if any part not clear, you guys can ask me. I'll try my best to answer. Do you recommend NA? Yes, you can use MA as well. So you see this blue line and this red line, this is part of the Ichimoku. It is a kind of moving average, right? It is a kind of a moving average. When Fibonacci webinar will be, I don't think it's anytime soon. It's probably in a few months because after this, we're gradually touching on the basics. We have to touch on a lot of things: trading psychology, risk management, candlesticks pattern. Do you see all these candlesticks? There's so many patterns. There's a doji, there's spinning top, there's a hammer. Oh, again, last thing you want to combine is after you found your analysis, you want to wait for price to come to your entry and then wait for the candlesticks pattern for the confirmation. For those who don't know, I won't be able to guide you today because it's a totally topic on its own, but these are some of the candlesticks patterns. Okay, that means, for example, let's look at this. Price is moving an uptrend. You see this evening star, this pattern here. It means this candle is signaling to you that price is going to do a reversal soon. Okay, so if you see a reversal candlestick pattern from here, it makes your trade even more probable. Okay, it makes your trade even more probable. Yeah, so nice job. Very straightforward. Teaching the thing in bets is the right thing to do. Yes, thank you, Alejandro. Probability. Everything you do in life is probability. Thank you so much, Francis. Okay, I will catch you guys. Today is Wednesday. I think we have a live analysis session tomorrow. That won't be, I won't be doing that one. My boss, who taught me everything I know, will be the one taking technical analysis. Oh wait, sorry, live analysis tomorrow. Live analysis tomorrow is when we look for setups for you guys. Okay, we look for setups, buy entry, take profit, stop loss, right? Usually on a normal basis, we find at least 5 or 6 to 8. So if you guys are free, this is more for the people who already know how to trade. Okay, for the beginners, don't go in tomorrow and expect to find winning trades. Don't be like, okay, I'm going to join tomorrow. I'm expecting to have shopping money by tomorrow. Okay. This is mostly for those who are a bit more experienced tomorrow. But for the newer people, yes, do join as well. You can learn as you go. Okay. Thank you, RG. I will catch you guys probably next week maybe next week. Okay. Thank you. Thank you, Spencer. Thank you, Lirio. Thank you, Juha. I will catch you guys. Thank you, Francis. I'll catch you guys again soon. Bye.
Hello everyone, my name is Emily and welcome to our daily trading tips. When you're about to begin trading, the best thing to do is start small. Choose only a couple of trading instruments, familiarize yourself with their past price action, and make sure that you perform technical analysis on multiple time frames. Also, familiarize yourself with their fundamentals. For example, if you're about to trade Amazon, have a good look at what the latest developments are for the company, but also what events lay ahead that could affect the share's price. Your aim is to eliminate the surprise factor as much as you can. You don't have to risk a high amount. Keep the risk minimized by investing low initially, and don't forget to set up a stop loss order and a profit-taking level. Your aim should be to learn and familiarize yourself with trading, but at the same time to preserve or even increase your capital. One of the best strategies to develop when you're trading is figuring out your best entry point. In most cases, the trader will observe that their entry point could have been much better if the proper circumstances were in place. So what are the best circumstances for identifying the best entry point? We suggest the trader accurately identifies the trend line of the asset working with technical analysis, and at the same time use a reliable fundamental story that could act as a foundation for the idea to materialize. This can be economic data of a currency or a company, commodity, or simply a booming industry that has chances of growing substantially in the near future. If the trader can choose the entry point strategically, there is a way to minimize actual risk of the trade with an equivalent stop loss not far away from the opening. Working with this strategy will require patience and persistence, as it is rather difficult skill to develop, but tends to pay extraordinary returns when utilized properly. I want traders to take a moment and consider what their strong points and what are their weaknesses in regards to trading. Let's say you've been trading for some time and it's finally working out for you. The question is, what can take you basically to get to the next level? How can you create a breakthrough for yourself as a trader? One of the things that good traders tend to do is identify what their superpower is. Are you a natural seller or are you a buyer? Are you better at trading stocks or gold? Knowing what you're good at and how you can further improve is what you need to transform yourself. Always keep in mind The work you put in a day and day out will determine who you will be in the future. So do the work and stay positive. Thank you so much for joining us, guys, today, and stay tuned for our tomorrow's live. Bye-bye.
Commodities are the natural resources that make up the building blocks of the global economy. Hard commodities are mined or extracted from the earth and include gold, oil, copper, and natural gas. These include agriculture products such as coffee, wheat, and lumber, and livestock such as hogs and cattle. Commodity prices are mainly determined by supply and demand, the weather, global economic development, and technological advances, political events, and the US dollar. For instance, changes in supply have an impact on the demand, so low supply leads to higher prices. In the agriculture sector, grains can be very volatile during the summer months or during any changes in the weather. Population growth and limited agriculture supply can provide opportunities to profit from increasing agriculture commodity prices. Trading CFDs on commodities is the most convenient way to access the commodities markets. A CFD is an agreement between the buyer and the seller that pays the difference in the settlement price between the open and closing trades. With CFDs, you're speculating whether the value of the instrument will rise or fall. One of the benefits of CFD trading is that you're trading on the expectation of a price movement, so you don't actually buy or take physical possession of the underlying asset, and you can still make a profit when the price of the commodity falls in value, not just when it rises. CFDs give commodity traders much more flexibility and more opportunities to earn from market movements. Commodities are an ideal way to diversify your portfolio. The prices of commodities tend to move in the opposite direction to stocks, so investors also demand on commodities during periods of market volatility. In particular, investors choose to invest in precious metals, particularly gold, which is known as a safe haven asset. Another reason is that precious metals can be used as hedge against periods of high inflation or currency devaluation. However, commodities can be risky investments because they can be affected by uncertainties that are difficult to predict, such as unusual weather patterns, epidemics, and natural and human-made disasters.